Hi, I'm Bill Boersma, founder and principal of OC Consulting Group. This video is a discussion of life insurance performance. Too often my work results in me having to tell someone a life insurance policy is underperforming expectations. There is such a lack of understanding about how life insurance works that sometimes it's difficult to have a meaningful conversation. It is not easy to destroy a foundation that someone believes is sound. Trying to relate that dutifully paying your premium every year may not result in a death benefit is not an easy message to internalize. Following is an analogy which almost anyone can understand as to why most life insurance acts the way it does. Let's look at your retirement planning. Hypothetically, when you are working, you're earning more than you're spending. Earnings over and above living expenses are put in a side fund which earns a return and grows over time. Then, in the future, when you are retired and your living expenses exceed your earnings, expenses are subsidized by the side fund so that you don't starve to death. If you understand this, you can understand modern life insurance. So here we go. With life insurance, your premiums today are greater than the actual cost to insure you. The excess is put into a side fund which earns a return over time. Then, in the future, when the cost to insure you is greater than the premium, expenses are subsidized by the side fund so the policy doesn't starve to death. So far so good? Let's go a little farther. Your retirement funding is based on some expectations and assumptions. In order to know how much to contribute to your retirement plan every year, you need to make some assumptions regarding your living expenses in retirement and your earnings over the coming decades. Sometimes this works out and sometimes it doesn't. Sometimes your expenses are going to be greater than you thought. Sometimes you aren't going to earn as much on your investments as you expected. When this happens, you intellectually know that the formulas you originally worked by aren't going to pan out and you have to adjust. This could mean putting more money into your retirement plan. This could mean reducing your expectation of your retirement standard of living. With life insurance, the funding is also based on some assumptions and expectations. In order to know how much to pay in premiums for a certain number of years, you have to make decisions. These decisions include how much insurance you want in force and for how long, how much you care about guarantees, your focus on cash value, the potential variability of expenses, and the assumed earnings over the coming decades. This may work out as expected, or it may not. Sometimes your expenses are going to be greater than you thought. Sometimes you aren't going to earn as much on your cash value as expected. When this happens, you need to understand that the formulas you originally worked by aren't going to pan out and you have to adjust. This could mean putting more money into your policy. This could mean reducing your death benefit or your expectation of how long your policy will last. Are your retirement earnings guaranteed? Generally, no. Is life insurance guaranteed? Most policies are not. Are retirement expenses guaranteed? Not usually. Are policy expenses guaranteed? Not usually. If you don't earn what you expect in your retirement plan, you know things will not magically pan out. If policy owners truly understood life insurance and they realized the projected crediting rate wasn't being realized, they likely wouldn't expect their life insurance to magically perform as expected. So what's the difference? It's a lack of understanding. Prior to, let's say, the 1970s, life insurance was a fixed product. There were rate books and an agent could calculate the premium, cash value, and death benefit for any given year for someone. There weren't any moving parts and things were guaranteed. That's it for today. In part 2, we will further discuss the important aspects of understanding life insurance. See you then.